So you're thinking about selling a second property here in the UK, but that potential tax bill is, well, it's a bit worrying, right? You've come to the right place. We're going to break down exactly how you can legally slash, or maybe even totally wipe out, the tax you pay on that sale.
And just so you know, this whole guide has been put together by the experts over at My Tax Accountant. That means you're getting solid, professional advice you can actually use.
All right, let's get right into it. Maybe you've got to buy it to let, a little holiday home, or a property you inherited. If selling has been on your mind at all, then what we're about to cover is something you absolutely need to hear.
Let's just start with this number, 24%. Wow, that is the highest tax rate you could end up paying on the profit from your sale. But, and this is a big but, the good news is you don't have to pay it.
So what exactly is this tax? It's called capital gains tax, or CGT for short. Put simply, it's the tax you pay on the profit, the gain, you make when you sell something that's gone up in value. And with property prices, those gains can be pretty massive.
Let's look at the numbers for the 2025-26 tax year. First off, you get a tax-free allowance, but it's only £3,000. Any profit you make above that tiny amount gets taxed. If you're a basic rate taxpayer, it's 18%, and if you're a higher rate taxpayer, it's that hefty 24%. You can see how quickly a property gain will blow past that allowance.
To see how this plays out in the real world, let's talk about Alex. Alex is a freelancer living in London. A while back, he bought a flat as a buy-to-let investment. He's selling up now and has made a very nice £100,000 profit. Great news for Alex, but this is when HMRC starts paying attention.
And boom, here's the damage. Because Alex is a higher rate taxpayer, once you take off his small £3,000 allowance, he's staring down the barrel of a tax bill of over £23,000. That is a huge slice of his profit, just gone.
Okay, but here's the kicker. What if Alex could legally, totally above board, shrink that bill, right down to zero? I know, it sounds almost too good to be true, doesn't it? But stick with me, because it's absolutely possible.
The secret weapon in your arsenal is something called private residence relief, or PRR. Honestly, understanding this one relief is the absolute key to saving yourself thousands, maybe even tens of thousands of pounds.
I mean, just look at this slide. The difference is just staggering. On one side, you've got Alex's painful tax bill, and on the other, with full private residence relief, that bill vanishes. It's gone. This is what we're aiming for.
So, how do you get your hands on this amazing relief? Well, a few boxes need to be ticked. The property has to have been your main home at some point. You can't have used a part of it only for business, and the garden has to be a reasonable size. But the most important part of that sentence is main home.
And here's a did you know moment for you. A lot of people have no idea about this. But if you own more than one home, you actually get to choose which one HMRC treats as your main residence for tax purposes. This isn't something that's decided for you. It's a strategic choice you get to make. The official term is nomination. It's pretty simple, really. You decide which home you want to nominate, and you pop a letter to HMRC. But, and this is so important, you only have a 2-year window to do this from the day you buy that second property. If you miss that deadline, you've missed your chance. Now, stay with me. This next part might really surprise you. You might be sitting there thinking, oh, but I only lived in that second place for a couple of months. Guess what? That's okay. Even a really short time living there can unlock some incredibly valuable tax relief. And get this, there's another fantastic rule. The last 9 months that you own a property are always exempt from capital gains tax, provided it was your main home at some point in the past. It's like a free bonus period built right into the tax system.
And we're not done yet. Now, this is where so many people trip up. They just look at what they bought it for and what they sold it for, and they totally forget to deduct all the costs they're allowed to. This is a huge mistake, and it costs people a fortune. So here's a massive pro tip. Keep a record of everything. We're talking about the stamp duty you paid when you bought it, all those solicitor and estate agent fees, surveyor's costs, and the big one, any major improvements. Think a new extension or a completely new kitchen. Just remember, things like a fresh coat of paint or regular upkeep don't count. It has to be a proper capital improvement.
Pro tip number 2. If you own the property with your spouse or civil partner, you both get to use your annual tax-free allowance, so that £3,000 instantly becomes £6,000. It's such a simple way to double your tax-free gain, but so effective. Okay, now this next tip is some seriously smart tax planning. You can actually transfer part or all of the property to your spouse completely tax-free before you sell it. So if you're a higher rate taxpayer and they're a basic rate payer, they could sell it and pay tax at 18% instead of your 24%. A move like that could save you thousands.
And for our last pro tip, think about when you sell. The rate of capital gains tax you pay is directly linked to your income for that year. So, if you can, try to sell the property in a tax year when your income is lower. Maybe you're about to retire, or you're taking a year off. Just doing that could drop your tax rate from 24% all the way down to 18%.
Okay, a quick but really important warning here. As soon as that sale goes through, a clock starts ticking. You've got just 60 days, that's 2 months, to report everything to HMRC and pay the tax you owe. Miss that deadline and you're looking at penalties, so you really need to be on the ball with this one.
As you can probably tell, figuring all this out, the reliefs, the rules, those tight deadlines, it can get pretty complicated. But getting it right can save you a serious amount of money, while getting it wrong can be a very expensive mistake.
And that's exactly why getting some expert help can make all the difference. To make sure your sale is as tax smart as possible, get in touch with the team at My Tax Accountant. You can drop them a message on WhatsApp or call them on 07854 255 375 or just send an email to info@mytaxaccountant.co.uk.
Hey, if you want more guides just like this, straight from the pros, make sure you hit subscribe on their channel. Because remember, the secret isn't just knowing the rules, it's about making them work for you. So let me leave you with this question. Are you really making the most of yours?